So now, accruing unpaid expenses. This type of adjusting entry recognizes expense that will be paid in future transactions. Therefore, no cost has yet been recorded in the accounting records. Salaries of employees and interest are borrowed money are common examples of expenses that accumulate from day to day, but that usually are not recorded until they are paid. So these expenses are said to accrue over time. That is, to grow or to accumulate. At the end of the accounting period, an adjusting entry should be made to record any expenses that have accrued but that have not yet been recorded, since these expenses will be paid at future date. So the adjusting entry consists of a debit to an expense account and credit to a liability account. And we shall now use the example for the firm JJ, but first I need to discuss that first the adjusting entry will be recorded that we are recognizing the expense that is incurred in that specific period, but it is a liability because the amount has not been paid yet. But when the current period has ended, and now in the future period when this amount will be paid off, so when the liability will be paid off, so you will record the entry that is the liability is debit and asset or cash is credit, right? So first you will record that, let's suppose salary expense, so you will record that salary expense debit and salary is payable credit because the expense has been incurred but the amount is not paid yet. But whenever you will pay that amount, you will record immediately a simple transaction, that is salary is payable debit and cash is going to be credit. So you can take an example of interest, wages and salaries, property taxes. So you can see that, let's suppose on Monday 29 to Wednesday 31st. So on May 31st, VATCO owes wages of 3,000. Payday is Friday, June 2. So if they are going to close their accounts on 31st of May, so 3,000 is the amount of wages that is incurred in that period, in that prior period, but the amount has not been paid. So the VATCO has to record an adjusting entry, that is the expense has been incurred, so the wages expenses is debit and wages payable is going to be credit. Okay, so this will become the liability. So wages expenses are debit, 3,000, and wages payable credit. So initially an expense and the liability are recorded. But whenever you can see that the balance sheet and the income statement effect, so the liability is to be paid in a future, so it is a liability, and when the liability is going to increase, it will be posted on the credit side. And here the expense is recognized because the cost is incurred and the amount has not been paid. But according to matching principle, if the expense is incurred, so you will have to record it. When the expense is going to increase, it will be posted on the debit side. So, and now we are adding one more thing, that is from 31st to 2nd June, that is on 1st June and 2nd June. Further, the wages expenses incurred, that is worth 2,000. So let's look at the entry for June 2. That is 3,000 was the expense of the prior period, and you have made an adjusting entry for that, that is wages expense debit and wages payable credit, and this is the current expenses that is incurred, and the payday is Friday, June 2. So how you will pass the entry? So wages expense for the month of June is 2,000, wages payable accrued in May, that is 3,000, and the total cash which is gone out, that is 5,000. So it is a weekly payroll for the May 29 to June 2. This was adjusted earlier, that is wages payable of 3,000 and cash 3,000 credited, and the current period expense is 2,000. So the liability is extinguished when the debit is paid. And the last and the fourth category or fourth type of the adjusting entry is accruing uncollected revenue. So a business may earn revenue during the current accounting period but not bill the customer until a future accounting period. This situation is likely to occur if additional services are being performed for the same customer, in which case the bill might not be prepared until all services are completed. Any revenue that has been earned but not recorded during the current accounting period should be recorded at the end of the period by means of an adjusting entry. This adjusting entry consists of a debit to an account receivable or revenue receivable and credit to the appropriate revenue account. The term accrued revenue often is used to describe revenue that has been earned during the period but not has been recorded prior to the closing date. So you can see the examples, as in for instance, interest earned, work completed but not yet billed to customers. So you can see that here for accruing uncollected revenue, let's say on January 31st, the bank owes VAPCO interest of 170. Interest is paid on the 15th day of each month. So that means from January 15 to January 31st, there are 15 days and the amount of revenue that is earned, that is $170. Okay? So at this moment, the adjusting entry would be passed, that is that the interest is receivable and interest income is going to be credited because you are recognizing the revenue in that specific period of time. So you can see that the interest receivable is 170 and interest income or interest revenue is going to be credited. This you have recognized the interest revenue. So the revenue is recognized and the receivable is created. But when you will receive this amount, so before that, at the time of adjustment, you will record that the balance sheet receivable to be collected in a future period. So this is your asset, and when the asset is going to increase, you will post it on the debit side. On the other hand, the impact on the income statement is revenue is earned in this period. So regardless that you have received that revenue or not, but you will record the interest revenue, and when this is increased, it will be posted on the credit side. So now let's say that from 1st of Feb to 15th of Feb, the further amount of interest revenue, 150, is been recognized or earned. So altogether, the total 320 monthly interest. So at this moment, the adjusting entry that has already been passed for 170 and you have received 320. So you will pass the entry, that is 320 you have received the cash, the interest revenue for the month of January that you had passed already as adjusting entry, that is 170, and the interest revenue for the month of Feb is 150. So this would be credited, right? Okay, so now accruing income tax expense, the final adjusting entry. Okay, so as a corporation earns taxable income, it incurs income tax expense and also a liability to the government tax authorities. So whenever you are going to pass the entry for the income tax, so it is simple. That is income tax expense debit and income tax payable credit, that is estimated income tax applicable to taxable income earned in the month of December. So this is basically a journal entry, or you can say that the expense that is incurred and it is not payable. So this is one of the adjusting entry you need to record for the income tax expense. Now, adjusting entries and accounting principles. So the adjusting entries are the means by which accountants apply the realization and matching principle, which we had discussed in detail in our previous lecture. Though these entries, revenues are recognized as they are earned and expenses are recognized as resources are used or consumed in producing the related revenue. In most cases, the realization principle includes that revenue should be recognized at the time goods are sold or services are rendered. At this point, the business has essentially completed the earning process and the sales value of the goods or services can be measured objectively. At any time prior to sale, the ultimate sales value of the goods or services sold can only be estimated. After the sale, the only step that remains is to collect from the customers, and this is usually a relatively certain event. The matching principle underlies such accounting practices as depreciating plant assets, measuring the cost of supplies used, and amortizing the cost of unexpired insurance policy. All end of the period adjusting entries involving expense recognition or application of the matching principle. So you can see that costs are matched with the revenue in two ways. One is the direct association of cost with specific revenue transaction, and other is the systematic allocation of cost over time, useful life of the expenditures. So now, the last concept which we need to discuss, that is the concept of materiality. This is very interesting. Like, say for example, we used to define the non-current assets and fixed assets on the basis that if it gives you benefit for more than 1 year. So we used to brought it forward as a capital expenditure in the balance sheet. That means first you used to capitalize it, and then you will depreciate that plant or machinery over the number of years it will be useful for us. That is depreciation, or sometimes it is amortization if it is an intangible thing. Let's suppose I have an ashtray in my firm, or a paper holder, or an stapler. That is also considered as a long-term asset because it can give me benefit for more than 1 year, right? In that situation, what should I do? That let's suppose I have purchased that stapler or that ashtray at a price of 50 bucks. So should I divide it by its useful life? Like let's suppose its useful life is 10 years, so 50 divided by 10, that is I used to adjust 5 rupees depreciation or $5 depreciation every year. Absolutely not. We have a materiality concept. That is another underlying accounting principle also plays a major role in making of adjusting entry, the concept of materiality. The term materiality refers to a relative importance of an item or an event. An item is considered material if knowledge of the item might reasonably influence the decisions of users of financial statement. Accountant must be sure that all material items are properly reported in financial statement. However, the financial reporting process should be cost effective. That is, the value of the information should exceed the cost of its preparation. By definition, the accounting treatment accorded to immaterial items is of little or no consequence to decision makers. Therefore, immaterial item may be handled in the easiest and more convenient manner. The concept of materiality enables accountant to shorten and simplify the process of making adjusting entry in several ways. For example, business purchase many assets that have a very low cost that will be consumed quickly in business operation. For example, including, as I told you, the staplers, the waste basket, light bulbs, janitorial supplies. The materiality concept permits charging such purchases directly to expense account rather than to bring it in the asset account and then adjust it over a period of time, or every accounting period you need to make the adjustment for that. So it is better that you can just expense it out directly, as you know, you need not to capitalize it and expense it out. So this is all. So we have noticed that we have posted the journal entries, and after journalizing we have copied the journal entries and posted in the ledger accounts like T accounts and with their respective heads, and after posting them in the ledger accounts we have carrying the balance brought forward to the next step, that is trial balance. And after preparing the pre-adjusted trial balance, now the fourth step, that is make end of year adjustment. So after adjusting entries, we will move on to the next part in our upcoming lecture, that is we will prepare the adjusted trial balance after making the adjustment. So
thanks for watching. For new video updates, press subscribe button so you will notified.